you paid off your mortgage. The loan is gone, the letter from the bank says, paid in full. And for the first time in maybe 30 years, you don't owe anyone a house payment. That feeling is real, and you earned it. But here's what almost nobody tells you at that moment. Your mortgage was never your only housing cost. It was just the biggest one, and the one that got all the attention. Once it disappears, 5 other costs are still standing there, quietly waiting, and some of them get bigger. Every single year you own that home, whether or not you're paying anyone a dime of interest. If you're sitting on a home with no mortgage and you've started treating your housing cost as zero in your retirement budget, this video is for you. So, is this video if you're a widow or widower now managing that paid off home on your own for the first time, without a spouse who used to handle the insurance renewals or the property tax notices? And so is this video if you're an adult child helping a parent figure out what a free and clear house actually costs to keep running, especially if that parent has started saying things like, "Don't worry about us, the house is paid off." None of this means you made a mistake by paying off your mortgage. Paying off debt before retirement is still one of the smartest, most stabilizing moves a person can make. It means the math didn't stop the day you made that last payment. It just changed shape. And almost nobody sits you down to explain how. By the time we're done today, you'll know what these 5 costs typically run in real dollars, why several of them have been rising faster than general inflation over the last few years, and one thing in particular that catches families off guard involving long-term care, Medicaid, and a home nobody thought they'd ever have to give up. Stick with me, because the 5th one is the one that shows up years later, often after the person is no longer around to explain it. If you find this useful, a like helps this reach more people your age who are quietly assuming their housing cost dropped to zero the day the mortgage did. Let's get into it. Cost 1. Property taxes don't care that you paid off the loan. While you had a mortgage, most lenders required you to pay into an escrow account every month, and they handled your property tax bill automatically behind the scenes. It felt bundled into one payment, almost invisible. The moment that mortgage is gone, the escrow account closes, and that bill doesn't disappear with it. It lands directly in your mailbox, usually once or twice a year instead of monthly, which can make it feel like a much bigger hit, even when the actual dollar amount hasn't changed at all. And in most parts of the country, the amount itself keeps climbing. Nationally, the typical single-family home carried a property tax bill of roughly $4,400 in 2025, and that figure had been rising a few percent a year even in markets where home values themselves cooled off slightly because local governments reassess based on the home's value on record, not on whether you still owe a bank anything. The effective tax rate nationally sits right around 0.9%, but that number hides enormous variation by state. A $400,000 home in New Jersey can carry a property tax bill close to $9,000 a year. The same home in a lower tax state like Alabama might owe well under $2,000. Some states offer meaningful relief here, including homestead exemptions or senior freeze programs that cap how much your assessed value can rise once you hit a certain age. And it's worth finding out whether your state or county offers one, because many eligible homeowners never apply. But absent that kind of exemption, the point stands. This bill is permanent, it typically rises over time, and once the mortgage is gone, you are the one who has to notice it's due, set the money aside, and write the check without a bank quietly doing it for you in the background. Cost 2. Homeowners insurance has gotten a lot more expensive, and it isn't guaranteed to renew. This is the cost that's changed the most in just the last few years, and it's the one most retirees are least prepared for. The average homeowner's insurance premium has climbed roughly 46% nationwide since 2021, driven by a combination of more frequent and more severe weather events, sharply higher rebuilding and construction costs, and insurance companies pulling back from higher-risk markets altogether. In parts of Florida, California, and several Midwest states that have seen major hurricanes, wildfires, or convective storms in recent years, some homeowners have received non-renewal notices, meaning their existing insurer simply declined to continue covering the home at any price. That often pushes the homeowner into a state-backed plan of last resort, which typically costs more and covers less than a standard private policy. Florida homeowners, for example, now pay some of the highest premiums in the country, with average annual costs approaching triple the national figure in some regions. Here's what most people miss about this particular cost. When you had a mortgage, the bank required you to carry adequate insurance as a condition of the loan, and it was actively monitoring to make sure you did, because the house was collateral for their money. Once the loan is paid off, nobody is checking anymore. There's no institution watching your renewal date, your coverage limits, or whether your premium quietly doubled because of a rate filing you never noticed. It becomes entirely your own responsibility to open that renewal letter, question a sudden rate increase, and shop for alternative coverage before a gap opens up. Skipping a renewal notice on a paid-off home, thinking it's just routine paperwork, is one of the easier and more common ways retirees end up with no coverage at exactly the wrong moment, sometimes discovering the gap only after a storm has already caused damage. Cost 3. Repairs and replacements now come entirely out of your pocket on your own timeline with no reserve fund built in. While you had a mortgage, many lenders required a home inspection before closing, which at least gave you a snapshot of the condition of the roof, the furnace, the water heater, and the major systems at that point in time. Once you own the home free and clear, there's no lender checking in on the condition of anything ever again. And critically, there's no escrow account quietly building up reserves for the next big repair the way there might be in a condo association or a newer planned community. Every major system in a home has a finite lifespan, and most retirees are living in homes that are decades old. A roof replacement can run anywhere from roughly $9,000 to $20,000 depending on the size of the home and the materials used. A new HVAC system, furnace and air conditioning combined, often runs $6,000 to $15,000. A water heater might be a smaller expense on its own, often $1,500 to $3,000 installed, but it tends to arrive alongside other aging systems rather than by itself. Add in a sump pump, a driveway that needs repaving, a deck that needs rebuilding, or a septic system that needs servicing, and you can see how these expenses stack up over a retirement that might last 20 or 30 years. None of these costs check your calendar before they show up, and none of them care whether you are trying to keep your taxable income low that particular year for Social Security or Medicare purposes. If you haven't built a separate home reserve fund specifically for this, a paid-off house can quietly force an extra, unplanned withdrawal from your IRA or brokerage account at exactly the wrong time, one that pushes you over a tax threshold you were otherwise managing carefully. Cost 4. The money is real, but it isn't liquid. And that illiquidity has its own quiet cost. This one is less obvious than the first 3 because it isn't a bill that ever arrives in the mail. It's an opportunity cost, and opportunity costs are easy to ignore precisely because nobody sends you an invoice for them. If a large share of your net worth is sitting in home equity, that money isn't generating retirement income the way a brokerage account, an IRA, or even a simple bond ladder does. Financial planners sometimes describe this situation as being house rich and cash poor. Your home might be worth $500,000 or more on paper, but unless you sell it, downsize into something smaller, take out a home equity line of credit, or use a reverse mortgage, that value can't cover a grocery bill, a Medicare Part B premium, or a property tax payment. Meanwhile, that same $500,000, if it were instead invested in a diversified portfolio of stocks and bonds, could realistically be generating income you could actually spend every single month, using even a conservative withdrawal approach. This isn't an argument that you should sell your home. Plenty of retirees rightly value the stability, the familiarity, the proximity to family, friends, and community that comes with staying exactly where they are. And that value is completely legitimate, even if it doesn't show up on a spreadsheet. It's simply a cost that almost nobody ever puts a real number on. The ongoing opportunity cost of a large amount of your net worth sitting locked inside 4 walls instead of working for your monthly cash flow, and understanding that trade-off clearly is different from being told you must give it up. Cost 5. What happens to that equity if you ever need long-term care, or when the home is eventually sold? This is the cost that surprises families the most because, unlike the other 4, it usually doesn't show up while you're actively paying attention. It shows up either very late in life or after death, when the person who understood the finances best may no longer be around to explain what's happening. Here's the first part of it. If you or a spouse ever need nursing home care and apply for Medicaid to help cover the cost, your primary home is generally protected and considered an exempt asset while you're still living in it, as long as your equity in that home stays under a set limit. For most states in 2026, that limit is either around $752,000 or as high as $1,130,000, depending on which figure your particular state has chosen to use. And California currently applies no home equity limit at all. But here's the part that catches people off guard. That protection during your lifetime doesn't mean the story simply ends there. After a Medicaid recipient passes away, most states are federally required to attempt to recover the cost Medicaid paid for that person's long-term care from their estate through a process known as the Medicaid Estate Recovery Program. For many families, the home is by far the largest and sometimes the only significant asset left in that estate. In other words, the house can be fully protected and exempt while you're alive, and still become the source of a claim against your family afterward, sometimes forcing heirs to sell a home they'd hoped to keep in order to satisfy that recovery. There are protections in many states for a surviving spouse still living in the home or for a disabled child. So this doesn't apply universally, but it's a rule almost nobody learns about until it directly affects them. Separately from long-term care entirely, there's a second surprise waiting in the ordinary tax code, one that applies to essentially every homeowner who eventually sells. Since 1997, the IRS has allowed a homeowner to exclude up to $250,000 of capital gain on the sale of a primary residence if filing single, or up to $500,000 if married and filing jointly. And that limit has never once been adjusted for inflation in nearly 30 years. A home purchased decades ago for $150,000 that's now worth $700,000 or more, which is an increasingly common story in many parts of the country, can easily push a long-time owner, and especially a surviving spouse, selling a loan at the lower $250,000 limit instead of the $500,000 married limit, over that threshold and into a real, sometimes unexpected, capital gains tax bill. Let's put real numbers around all of this together because the individual pieces are easier to understand once you see how they land on one household in a single year. Frank and Diane are 68 and 66, both fully retired, and they paid off their home in a coastal town 3 years ago after nearly 3 decades of mortgage payments. Their house is currently worth about $650,000. They owe absolutely nothing on it. And for the past few years, they've quietly told themselves their housing cost is basically down to zero, aside from ordinary utilities and the occasional small repair. Here's what actually showed up for them over the last 12 months. Once they finally sat down and added it all up, their property tax bill came to $6,100 for the year, reflecting a recent reassessment after home values in their county rose. Their homeowner's insurance renewal jumped 22% in a single year, landing at just over $3,400 after 2 hurricanes made landfall within a few hundred miles of their region. The prior season, even though their own home wasn't directly damaged. Their water heater failed unexpectedly in February, an unplanned repair and replacement that cost $1,900. Added together, that's more than $11,400 in a single 12-month period, money that had to come from somewhere. And in Frank and Diane's case, it came from an extra, unplanned IRA withdrawal they hadn't budgeted for at the start of the year. That extra withdrawal didn't just cost them the tax on the withdrawal itself. It also nudged a larger portion of their Social Security benefit into taxable territory for that same year because it pushed their combined income over one of the thresholds that determines how much of their benefit gets taxed. None of these individual events were catastrophic. No single one of them, on its own, would have derailed their retirement. They were simply the ordinary, predictable cost of owning a valuable home, arriving together in one 12-month stretch because nobody had ever budgeted for them separately, or set money aside in advance specifically to absorb them. If Frank and Diane had instead set aside roughly 1.5 to 2% of their home's value each year, which in their specific case would have meant somewhere between $9,750 and $13,000. Sitting in a dedicated home reserve account, all 3 of those costs could have been absorbed calmly without touching their investment accounts at all, and without accidentally increasing how much of their Social Security got taxed that year. Now, a few honest exceptions worth naming, because this isn't meant to be a universal rule that applies identically to every single viewer watching. If you live in a genuinely low tax, low insurance cost state, and your home's value is well under $250,000, several of these five costs shrink considerably in real dollar terms, and this entire conversation may matter far less for your specific situation than it does for someone in a higher cost coastal state. If you plan to age in place with support from family members rather than moving into facility based long term care, the Medicaid estate recovery issue in Cost 5 may never actually come into play for your household at all. If your primary goal has always been to leave the home to your children, regardless of what it costs you along the way, the opportunity cost argument in Cost 4 may reasonably matter less to you than the stability and legacy the home represents. And that is a completely legitimate value to hold, not a financial mistake. And if your state offers a strong senior exemption, a homestead exemption, or an assessment freeze once you reach a certain age, your actual property tax bill may run well below the national figures mentioned in this video. So it's worth checking rather than assuming the national average applies to you. Here's your practical next step, and it genuinely shouldn't take more than an hour or two of your time this week. Pull your most recent property tax bill and your most recent homeowner's insurance renewal notice, and write both totals down side by side on a single piece of paper so you can see your true annual housing cost in one place instead of scattered across different envelopes throughout the year. Call your insurance agent directly and ask two specific questions. Has your policy renewed without incident over the last 2 years? And are you currently at any risk of a non-renewal given your location and claims history? Walk through your home, room by room if needed, and make a rough written estimate of how many years are realistically left on the roof, the HVAC system, and the water heater, so a major repair never arrives as a total surprise. And if long-term care is a realistic possibility for you or your spouse at some point in the next decade, which for most people over 65 it statistically is, have one honest, unhurried conversation with an elder law attorney or a fee-only financial planner about exactly how your specific state's Medicaid home equity limit and estate recovery rules would apply to your particular home and your particular family situation. This video is for education, not individualized financial, tax, legal, or long-term care planning advice. Property tax rates, insurance markets, Medicaid rules, and estate recovery procedures all vary significantly from state to state, and they change over time as laws and local budgets shift. So please verify the current figures that apply specifically to your own state, and review any major decision with a qualified professional who can look at your complete situation. A paid-off home is still, without question, one of the strongest financial positions a retiree can be in. Owning it outright removes the single biggest fixed cost most working people carry for most of their adult lives. And that accomplishment is genuinely something to feel proud of, not something to second-guess. The goal of this video was never to make you afraid of your own house, or to suggest that paying it off was somehow the wrong move. It was to make sure the number sitting in your retirement budget actually reflects what the home costs you today, rather than what it used to cost back when the bank was quietly collecting and managing all of it on your behalf. Know your real number. Keep a reserve set aside for the years when several of these costs land at once, and that paid-off home stays exactly what it should be for you. One of your biggest sources of security in retirement, rather than a quiet, occasional source of financial surprises. If this helped you see your own home a little differently, subscribe so you don't miss the next video, where we'll walk through exactly how to build a home reserve fund step by step, without disrupting the rest of your retirement withdrawal strategy or accidentally pushing yourself into a higher tax bracket along the way. Thanks for spending this time with me today.